You ever scroll through Craigslist at 2 in the morning and wonder if that 20-unit apartment building listed between a used couch and someone's pet hamster could actually be your ticket to generational wealth? Here's the thing. You absolutely can underwrite a deal from a Craigslist ad, but whether you should is where this story gets interesting. Right now, thousands of wannabe real estate moguls are doing exactly this, armed with nothing but a smartphone calculator and a dream, while seasoned investors are pulling back from the market entirely. Cap rates have compressed to levels we haven't seen since 2006. Interest rates have tripled in 18 months. And that screaming deal you found might actually be a screaming disaster wrapped in terrible photos and vague income numbers. So why are people still doing this? Because Craigslist, for all its sketchy glory, remains one of the last places where motivated sellers actually post deals before they hit the MLS or get scooped up by institutional buyers, with algorithmic advantages you can't compete with. Think of underwriting like being a detective who's been handed a ransom note made from magazine clippings. You've got fragments of information, maybe some grainy photos, a price that seems too good or suspiciously round, and you need to reverse engineer whether this is legitimate opportunity or a spectacular waste of your Saturday. The classic Craigslist ad gives you almost nothing. 20 units, asking price 1.2 million, cash flow positive, and a phone number that may or may not connect to someone who actually owns the property. From this breadcrumb trail, you're supposed to build a financial model that could determine your next decade. But here's where it gets wild. Remember when everyone thought real estate only went up? When house flippers were treated like financial geniuses on HGTV? And your cousin Brad bought 3 duplexes with no money down? That era ended badly. Yet here we are again, with people convincing themselves that incomplete information is just part of the adventure. The psychological whiplash is real. One day you're reading headlines about rental demand staying strong and demographic tailwinds, and the next you're watching commercial real estate headlines predict an apocalypse, while your spreadsheet is telling you the numbers still work if you squint hard enough. Warren Buffett says, "Be fearful when others are greedy, and greedy when others are fearful." But what do you do when half the market is greedy and half is fearful, and you're sitting there with a Craigslist ad that might be either? The paralysis of analysis becomes real when you realize that every assumption you make about rent growth, vacancy rates, and exit cap rates could swing your internal rate of return by double digits. History shows us that real estate moves in cycles, typically 7 to 10 years. And we're sitting in a weird middle period where prices haven't crashed, but enthusiasm has definitely cooled. I'll be honest, I missed the boat on deals in 2010 and 2011 because I was convinced the world was ending and everything would get cheaper, and spoiler alert, it didn't. The community wisdom right now is split down the middle. Half the Reddit threads and Bigger Pockets forums are screaming, "Wait for the crash," while the other half is documenting deals they're closing and arguing that paralysis costs more than overpaying by 5%. Both sides have compelling arguments, both sides have data, and both sides think the other side is delusional. Let's kill the biggest misconception right now. You cannot accurately underwrite a deal from a Craigslist ad alone, but you absolutely can determine whether it's worth pursuing. The ad is your filter, not your final answer. And anyone who tells you they bought a building sight unseen based on 3 sentences and a blurry photo either got incredibly lucky or is lying to you. Here's your practical playbook. Take the asking price, divide by the unit count to get price per door, compare that to market comps in the area, then work backward to figure out what the net operating income would need to be to justify that price at market cap rates. If the math even remotely works, you make the call, and if the seller can't provide a rent roll, 12 financials, and basic property details within 48 hours, you walk. The lesson from every cycle is the same. Discipline beats conviction. Position, sizing beats timing. And the investors who survive are the ones who didn't bet the farm on any single deal, no matter how good it looked. Your edge isn't finding the deal. It's having the process to evaluate it quickly and the courage to walk away when the numbers don't work, even when your gut is screaming that you're missing out. At the end of the day, I'm completely comfortable whether this building on Craigslist turns out to be the deal of the decade or a money pit that would have destroyed my portfolio, because I know I'll run the numbers, verify everything twice, and size my bet appropriately if I move forward. The market will do what it does. Buildings will trade hands. And somewhere between the doomers predicting collapse and the optimists seeing opportunity everywhere, there's a rational path forward that doesn't require perfect information, just honest analysis and emotional discipline. If you're serious about finding investment properties beyond sketchy Craigslist ads, check out www.growthsense.com, where you can search legitimate investment property listings and connect with sellers in a platform built specifically for real estate investors.